Patrick Industries completely smashed bottom-line consensus for Q2 2026, though they just barely missed on top-line revenue.
Right, they came in with net sales of $1.04 billion.
Exactly, and earnings per share hit 1.28, which is a massive 33% jump. They did lower their full-year RV shipment guidance to that 285,000 to 300,000 range, but the stock actually held up remarkably well after the report dropped.
Yeah, it really did hold its ground. And honestly, it is one of the most counterintuitive financial snapshots you will come across this season.
It really is. So we are putting on our financial analyst hats for this deep dive, and we're inviting you to do the same. We're tearing into Patrick Industries, ticker symbol PATK, looking at their Q2 2026 earnings presentation and the official news release.
Right, because our mission today is to figure out how a behind-the-scenes supplier is pulling profits out of a consumer discretionary market that is, frankly, frozen solid right now.
Yeah, I mean, imagine walking onto a premium boat dealership lot right now. It's a complete ghost town. Interest rates are high. Confidence is shaky, and basically nobody is financing a $150,000 wakeboard boat.
No, definitely not. The whole recreational industry is just stalled.
Right. Dealerships are cutting orders, but the company building the guts of those boats, they just posted a 34% jump in net income.
Which is wild, because when you think about RVs or marine powerboats, you immediately think of the big brand names, right? The OEMs.
Yeah, the logo on the side of the fiberglass.
Exactly. You don't necessarily picture the completely fragmented supply chain actually making those vehicles possible.
A great way to visualize Patrick Industries is, well, think of them as the Intel Inside of the outdoor enthusiast world.
I like that.
Yeah, you aren't buying a Patrick brand boat, but if you buy a premium fifth-wheel camper, Patrick likely supplied the fiberglass siding, the wiring, the custom cabinets, the seating.
They are the internal organs of the whole operation.
Exactly. And to understand their health this quarter, we have to unravel this huge top-line paradox in their numbers. Let's look at the raw data.
Yeah, because the headline numbers side by side, they present a very weird picture.
Net sales were virtually flat. Like we said, $1.04 billion in Q2. That is down just 0.6% from the $1.05 billion they made in Q2 of 2025.
The top-line revenue basically didn't move an inch.
Right. But despite that stagnant revenue, net income jumped 34% to $43 million, and diluted earnings per share increased 33% to 1.28.
Which looks absolutely phenomenal on a press release, right? Flat sales, but way higher profits.
Everybody loves that.
But any seasoned financial analyst is going to immediately look past net income and check the operating margins. You have to see how the core business is actually functioning.
And when you look at Patrick's adjusted EBITDA, which is just earnings before interest, taxes, depreciation, and amortization, it was $126 million.
Right, which represents a 12.1% margin. And that's actually a noticeable dip from the 12.9% margin they had last year.
Yeah, the compression doesn't stop there. Their overall operating margin dropped too, falling to 7.4% from 8.3%.
And management was pretty transparent about why. Higher global oil and fuel prices, which led to freight surcharges, plus some heavy administrative costs from recent merger activities.
So we have a huge disconnect here. Operating margins shrink, adjusted EBITDA is down, and revenue is totally flat. Logically, profits should be taking a hit.
Exactly. So why did net income and EPS spike over 30%?
What's the accounting trick there?
It comes down to a very specific, favorable year-over-year comparison.
Okay.
In Q2 of last year, 2025, Patrick absorbed a massive $24 million legal settlement expense.
Oh, wow, $24 million.
Yeah, it was a one-time anomalous hit that just completely dragged down their net income last year. So because that expense didn't repeat this year, their 2026 net income artificially looks like it skyrocketed.
Wait, let me pause you there. Because if we strip away the noise of that legal settlement, the narrative totally flips.
It really does.
Revenue is stagnant, margins are shrinking due to freight costs, and if you compare apples to apples, their adjusted net income actually fell from $51 million last year to $44 million this year.
That's the reality of the core operations, yes.
So how on earth is management presenting this as a win for retail investors, and why isn't Wall Street punishing the stock?
It's a victory of relativity. You have to roam out and look at the macroeconomic storm destroying the rest of the industry right now.
Right, the whole consumer discretionary sector is heavily constrained.
Exactly. Because interest rates are elevated, financing a $100,000 RV is literally thousands of dollars more expensive over the life of a loan than it was 3 years ago.
Dealerships know consumers are stretched thin, so they are just not ordering new units.
Yep. So the OEMs are bleeding, Wholesale shipments are seeing double-digit declines. In a macro environment where the total market is physically shrinking, the fact that a component supplier like Patrick kept revenue totally flat, that is an operational feat.
They basically avoided the crash.
They did.
But how do you avoid a crash when your entire business is supplying parts to a crashing industry?
It brings us to their core survival mechanism. In their presentation, they outline a specific strategy around a metric called content per unit.
Right, they aren't just selling more volume, they're changing what they sell into the volume that exists.
Yes. Their portfolio has four main end markets: RV, marine, power sports, and housing. And this dynamic is super visible in RVs.
RVs are their biggest segment, right, like 39% of total revenue.
Exactly. And this segment took a heavy hit. Revenue fell 15% to $407 million.
Which tracks almost perfectly with the broader industry. The industry saw a 16% drop in wholesale RV shipments.
But here's where it gets interesting. That secondary metric content per unit tells a completely different story.
Industry shipments dropped 16%, but Patrick's content per RV unit, the actual dollar value of their products stuffed inside every single RV built, that grew by 7% to $5,303.
This is how they survive the downturn. They aren't sitting around hoping the industry magically sells more RVs. They just make sure they capture a larger share of the wallet for every single unit that does get manufactured.
Let's break down the mechanics of that. How does a supplier force that number up? Are they just jacking up prices on the same fiberglass?
No, it's mostly strategic acquisitions and product innovation. Like, Patrick regularly buys up smaller niche component makers.
Oh, so an OEM who used to buy flooring from Company A and cabinets from Company B is now just buying both from Patrick.
Exactly. But more importantly, they innovate integrated systems. Instead of just selling a steering column, they pitch the OEM a fully integrated premium digital helm station.
So the OEM buys it because it saves them assembly time.
Right, and it makes the RV look way more modern. And Patrick significantly increases their dollar content per vehicle.
It's like the luxury trim dynamic at a car dealership during a recession. Overall foot traffic is down, but in a high-interest environment, the only people still shopping for expensive toys are high-income buyers.
Yep, buyers who don't care about borrowing costs.
And they don't want the base model. They want the premium audio, the upgraded leather, the advanced HVAC.
And Patrick is the one supplying those exact premium upgrades. You see this play out even more wildly in their marine segment.
Okay, marine is 18% of their revenue. And the revenue here surged 22% to $191 million.
But the context is insane. Wholesale powerboat shipments across the whole industry were completely flat. Zero growth in the physical number of boats built.
Yet Patrick's estimated content per unit in those boats climbed 22%. It reached $4,883 per boat.
For every single hull that went into the water, Patrick managed to sell 22% more value into it than a year ago.
That is a masterclass in internal market share. Boat builders are desperate to attract wealthy buyers, so they load the boats up with premium wakeboard towers and high-end Rockford Fosgate audio.
All supplied by Patrick, exactly.
Then we pivot to power sports, which is 12% of revenue. This is the undisputed star of the quarter. Revenue jumped 28% to $123 million.
And the growth here isn't just about luxury. It's a fundamental shift in consumer behavior. The presentation points out that demand for utility-focused units is exceptionally strong.
We are talking about rugged side-by-sides for commercial, farms, construction sites, that sort of thing.
Right. A farmer buying a utility vehicle views it as essential equipment. It's not a pure luxury toy, so that purchase is way less sensitive to interest rate hikes.
And Patrick is aggressively targeting this subsector. They supply heavy-duty add-ons through brands like Sportech.
Yeah, advanced cabin closures to protect workers, heavy-duty windshields, specialized climate control.
So the base vehicle from the OEM is just the canvas, and Patrick makes high-margin revenue on all the highly engineered components bolted onto it.
Exactly. So the diversification strategy is mechanically working. The RV market is in a deep trough, but the aggressive growth in marine and power sports neutralizes those losses, keeping the top line flat.
But recreational toys only tell part of the story. To understand their full operation, we have to look at the segment that has nothing to do with weekend recreation.
Right, where people actually live. Housing.
Housing makes up 31% of their total revenue. In Q2, it brought in $320 million, which is a slight 2% increase year over year.
But again, look at the macro environment. Wholesale manufactured housing, or MH shipments, dropped by 8%, Overall, traditional housing starts dropped by 1%.
And Patrick's content per unit in manufactured housing remained flat at $6,673.
So they are operating in a housing market that is just as frozen as the boat market.
Yeah, the presentation calls out the usual suspects. Elevated interest rates, making mortgages painful, affordability issues, low consumer confidence.
Right, if a family is priced out of a traditional neighborhood, they might look at manufactured housing. But if financing that manufactured home also carries an 8% interest rate, they just keep renting.
The demand is there, it's just bottlenecked by the cost of capital. But the earnings report highlights a very specific regulatory catalyst that could unblock this for Patrick.
Completely independent of interest rates, yes.
The Road to Housing Act, which became law in July of 2026. ROAD stands for Removing Our Affordable Development Barriers. What are the actual mechanics of this?
Historically, a huge bottleneck for manufactured housing isn't just financing, it's local zoning laws. Municipalities use aggressive zoning or aesthetic mandates to effectively ban manufactured homes.
Classic not in my backyard regulation.
Exactly. So a buyer qualifies for a loan, but literally cannot find a legal plot of land to place the home on.
Wow.
The Road to Housing Act is designed at the federal level to cut through that municipal red tape. It standardizes regulations so local councils can't arbitrarily block these developments.
That completely alters Patrick's total addressable market. They're sitting on immense pent-up demand.
The moment interest rates ease even slightly, this new regulatory environment is primed for a rapid surge in construction. Communities that were closed off will open up.
And Patrick is right there to supply the flooring, the countertops, and the fixtures for that wave of new builds. Okay, so we've mapped out the cash generation engines. Power sports resilience, marine market share grabs, the RV bottoming out, and the housing regulatory groundwork. The final piece for you, the retail investor, is analyzing how management is deploying the cash they're generating right now.
Capital allocation is the ultimate lie detector test for management. Ignore the press release quotes. Just look at where they write the checks.
And they are writing massive checks to their own shareholders. They returned $106 million to shareholders in Q2 alone.
That's a huge number.
It was split between $15 million in reliable dividends and a staggering $91 million used to repurchase 980,000 shares on the open market.
And to put that in context, they're doing this while maintaining very healthy liquidity. They have $691 million in available liquidity. And their net leverage ratio is at 3.0x.
For those unfamiliar with industrial leverage, 3.0x means their total debt is roughly 3 times their annual earnings before interest and taxes. In this space, that's a highly manageable cushion.
Right, they aren't overextended at all.
So they have ample cash, secure debt, and they're aggressively shrinking their share count. But they are doing this while simultaneously lowering near-term expectations.
Right, CEO Andy Nemeth stated point blank, they are not relying on a near-term market rebound.
Which makes the timing of their next major move totally fascinating. On June 30th, 2026, literally 2 days after this quarter officially closed, they signed a definitive agreement for an all-stock merger with LCI Industries.
Better known as Lippert. This is a seismic event in the supply chain.
Lippert is basically Patrick's most formidable rival. While Patrick focuses on interiors, cabinets, audio, seating, Lippert dominates exteriors and chassis, the heavy steel frames, the slide-outs.
They are merging to create a unified powerhouse.
But here is where I struggle with the capital allocation strategy.
Where's the disconnect for you?
The aggressive share buyback. They spent $91 million in cash to buy back nearly 1 million shares just weeks before announcing a massive all-stock merger. If you know you're about to use your stock as currency to acquire a competitor, why drain your cash reserves to buy your own stock first?
It is actually a brilliant mechanical move to protect their current shareholders. With an all-stock merger, the per-share value of your stock dictates your purchasing power.
Oh, I see.
Yeah, by spending $91 million to buy back shares right before the announcement, Patrick intentionally shrinks the supply of their stock on the open market.
Which mechanically pushes the value of the remaining shares higher.
Exactly. By boosting their own share price right before the merger, they ensure they have to issue fewer new shares to compensate the LCI stockholders. It prevents severe dilution.
It's management screaming to the market, "We believe our stock is deeply undervalued right now, and we are locking in that value before we merge."
Exactly. It's like a game of Monopoly. The macro environment is terrible, other players are low on cash, and Patrick is using the moment to quietly buy up the properties and consolidate the board.
Synthesizing this whole report, Andy Nemeth's philosophy is highly pragmatic. They can't control federal interest rates or force middle-class consumers to buy boats.
No, But they can control internal costs. They can buy back undervalued equity and execute M&A to eliminate a competitor.
They're using the broader market weakness to build an impenetrable balance sheet. So when discretionary spending inevitably turns, they emerge as the dominant force.
Which leaves us with a critical industry question to ponder as we wrap up.
Yeah.
If Patrick and LCI successfully navigate regulatory approvals and combine, they create an absolute behemoth.
We are talking about a level of consolidation the RV and marine markets have never seen from a single supplier.
The leverage shifts entirely.
Right. So the provocative question for you to think about is this. How will the major OEMs, the household brands like Thor Industries or Malibu Boats, react to having a single, massively powerful supplier holding all the cards?
Yeah, when it comes to pricing, logistics, and innovation, Patrick Lippert will hold a lot of power.
Does this merger permanently shift the balance of profit power from the brands building the vehicles to the supplier providing the guts?
It could completely restructure the profit margins of the outdoor industry for the next decade.
Keep analyzing the mechanics behind the numbers and always question the supply chain behind the products you buy. If you want to keep putting on that financial analyst hat with us, make sure to follow the show for our daily earnings coverage and market breakdowns. We'll catch you on the next deep dive.